Welcome to vTalkInsight, Market Drivers Daily for January 21st, 2026. Markets are juggling sharp geopolitical shocks, an AI, Capex supercycle, and surprisingly strong growth data, creating a tricky mix of volatility and opportunity to navigate. Geopolitics has moved back to the center of the macro story, with trade threats between the United States and Europe driving a clear risk-off tone across markets. Renewed talk of steep tariffs, including a potential 200% duty on French wine and champagne and broader levies linked to troop deployments in Greenland, is weighing on confidence even before anything is formally implemented. Equity markets are lower, volatility has spiked, and safe haven assets such as gold and silver are catching a strong bid. Under the surface, the trade conflict now has several moving parts that matter for pricing scenarios. On one side, Washington is signaling tariffs that could start around 10% and rise to 25% on some European partners, while a separate Supreme Court decision on existing tariff powers could affect roughly $150 billion of revenue. On the other side, Brussels is preparing potential countermeasures on around $100 billion of U.S. goods and even considering actions aimed at American tech firms, although officials still say they prefer diplomacy before pulling that trigger. Markets are responding through a classic but nuanced flight to safety. Gold has outperformed U.S. equities over the past year as central banks and sovereign wealth funds increase allocations, signaling a desire to diversify away from pure dollar exposure amid trade and capital frictions. Mining stocks tied to critical metals and rare earths are outperforming, while a Danish pension fund's exit from U.S. Treasuries highlights how some European investors are reassessing sovereign risk, even as broader Treasury selling from Europe has not materialized. Alliance politics are adding another layer to the risk premium, particularly around the Arctic. NATO members, including Canada, are lifting defense spending toward 3 to 5% of GDP and pushing the alliance to focus more on the Arctic and western flanks, as tensions over Greenland's minerals and shipping routes intensify. Compared with a few days ago, when Arctic frictions seemed to be settling into structured diplomacy, rhetoric has swung back toward confrontation, giving Russia and China more room to exploit divisions and keeping uncertainty around Ukraine and broader European security elevated. At the same time, there's a strong counter-narrative arguing that markets may be overreacting to headlines. Past tariff rounds saw most costs absorbed by U.S. businesses and consumers, with limited impact on European inflation or overall U.S. growth, and several earlier threats were never followed by formal tariff notices, which breeds skepticism about full follow-through today. European economies are still growing solidly. Some CEOs remain optimistic on deal-making, and there is clear political pressure in both Washington and European capitals to avoid a full-scale trade war, especially with diplomatic efforts around Greenland and Ukraine continuing. For now, geopolitical risk is clearly the primary catalyst behind equity weakness, higher volatility, and the strong performance of gold and critical metals. Key signposts from here will be any concrete tariff filings by the United States, the Supreme Court's ruling on tariff authority, the scale and targeting of any European retaliation, and signals from Davos or NATO on Arctic security cooperation. How those events evolve will determine whether today's risk premium in European exporters, U.S. financials, and safe havens persists or unwinds. And it sets the backdrop for our next topic, where AI investment is acting as a powerful medium-term counterweight to geopolitical stress. Artificial intelligence remains the dominant structural theme, with evidence mounting that we are in the early stages of a multi-decade investment supercycle. AI infrastructure demand is described as unprecedented as model developers and cloud providers race to secure computing power, driving massive data center build-outs and power requirements that look more like a new utility system than a traditional tech upgrade. This wave of spending is already a major contributor to U.S. growth and is reshaping where capital is flowing across sectors and asset classes. On the infrastructure side, Planned AI investments are running into the trillions of dollars, from custom silicon and memory to networking and physical plants. Large tech firms are locking in long-term GPU contracts, expanding U.S. semiconductor capacity, and securing copper, nuclear, and renewable energy to meet data center power needs, even as power availability remains a binding constraint in several grids. Financing is ample but not free, with data center Capex highly sensitive to medium and long-term yields. A projected $300 to $400 billion of new investment-grade issuance in 2026 and private credit partnerships, all supported by an estimated $2.5 trillion of extra lending capacity created by recent deregulation. Strategic positioning among the platforms is equally important for the outlook. Meta is pouring capital into U.S. AI infrastructure and leaning on a user base of 3.5 billion daily users and 1 billion monthly Meta AI users to distribute new products, while betting on smart glasses as the next interface for integrating AI into everyday life. Google and DeepMind are pushing their Gemini model to improve factual accuracy, reasoning, and privacy, with applications from weather forecasting to battery materials, while hyperscalers develop custom chips, such as Amazon's Trainium and energy-efficient ARM-based processors, to cut inference costs and defend margins. On the demand side, enterprise adoption is gathering pace, but still with large headroom. Early corporate users report roughly threefold returns from small-scale AI projects in areas like marketing and workflow automation, and some AI-focused companies are seeing revenue growth in the 300% to 400% range, even as many clients are only starting their journeys. Banks such as J.P. Morgan, with about 400 active AI projects, and Citi are embedding AI into automation and fraud prevention, helping deliver profit growth with flat headcount, while utilities like Southern Company see 8 to 10% growth driven by data center load, turning a traditionally defensive sector into an AI infrastructure play. Despite this momentum, the AI theme carries meaningful risks that markets are still calibrating. There is real uncertainty about the timing of transformative capabilities, such as broad deployment of autonomous vehicles, and some AI startups are expected to fail as funding tightens or revenue arrives more slowly than hoped, raising the danger of overextended balance sheets tied to specialized hardware. Power shortages, rising political pressure on tech firms to shoulder more grid costs, intensifying regulation around AI-generated content and child safety, and high concentration in a handful of richly valued U.S. leaders all add to the risk that a policy shock or growth disappointment could trigger a sharp valuation reset. Even with these caveats, AI is already reshaping macro dynamics and cross-asset pricing. Technology is estimated to account for about 40% of U.S. GDP growth over the past year, and a productivity boom reminiscent of the 1990s is being cited as a reason the economy might sustain strong growth without an immediate inflation spike, even as AI-driven Capex, fiscal stimulus, and tariffs pose upside risks to long-end yields into 2026. Key watch points now are the next leg of AI earnings and Capex guidance, long maturity funding costs for data centers, power policy decisions, and potential shifts in export controls on advanced chips, all of which will interact with the broader growth picture we turn to next. Beneath the geopolitical noise, the growth backdrop remains surprisingly resilient and increasingly broad-based. The United States is described as one of the strongest economies globally, with growth rates above 5%, stock markets near record highs, and unemployment close to full employment, while Europe is also expanding solidly despite recent risk-off moves. That combination of robust activity and elevated volatility is creating a regime where dispersion across sectors and regions, rather than outright recession, is the main challenge for capital allocators. In the U.S., several engines of growth are running at once. Business investment has surged, with capital expenditures up around 12% and supported by policies such as full expensing for equipment, alongside deregulation that has reportedly added $2.5 trillion of lending capacity, historically a backdrop associated with further employment and output gains. Consumer demand is robust across income levels, with spending growth in the mid-single digits, strong holiday activity, and anticipated tax benefits, while tech and streaming names like Netflix continue to add subscribers, grow international advertising businesses, and capture viewing time from linear television, signaling healthy underlying demand for digital services. Outside the U.S., growth is also showing encouraging breadth. Canada is positioning itself as an energy superpower, highlighted by new LNG export from British Columbia and higher defense, spending around 5% of GDP, while Nigeria has lifted growth from just above 2% to more than 4%, helped by macro reforms, fiscal consolidation, and a shift to refining its own crude. India stands out as a long-term winner, with strong consumer spending, manufacturing shift from China in areas like electronics, multiple IPOs, and technology-driven consumer platforms supporting expectations for robust equity returns and sustained expansion through at least 2026. Sector by sector, this growth shows up in concrete corporate behavior. United Airlines is reporting record business travel bookings and plans to add about 120 aircraft this year, including 20 wide-body jets, the largest such expansion by a U.S. carrier in decades, while capacity expansions are underway in high-growth consumer niches like protein drinks. Micron is committing $200 billion to new U.S. fabs. Utilities are drawing in growth-oriented investors thanks to AI-related power demand, and boards under pressure to deliver organic growth are turning more actively to mergers and acquisitions, supported by banks like J.P. Morgan expanding hiring and deal-making. However, the growth narrative is not without late-cycle warning signs. Trade and tariff uncertainty has contributed to a halving of U.S. private sector job growth, with firms facing unpredictable costs and some choosing to delay hiring or diversify supply chains and capital flows away from the U.S., even as consumer demand holds up. At the same time, rich equity valuations, heavy reliance on a narrow group of AI-driven leaders, and concerns that tariffs, AI investment, and fiscal stimulus could push inflation and long-end Treasury yields higher into 2026 all raise the risk that an exogenous shock could trigger a meaningful derating despite strong earnings. Putting it together, the current environment looks like robust but uneven growth under a cloud of policy and valuation risk. For multi-asset portfolios, the key questions are whether consumer and corporate spending can stay resilient if trade tensions escalate, how quickly AI-driven productivity gains filter into broader earnings, and whether emerging growth stories in markets like India, Nigeria, and Canada can offset any drag from a slower, more fragmented global trade regime. High-frequency indicators on consumer confidence, job creation, small-cap versus mega-cap leadership, cross-border capital flows, and long maturity yields will be crucial in gauging whether today's volatility is a buying opportunity for growth exposure or an early signal of a more persistent shift in the cycle. Across today's themes, the picture is one of strong underlying growth and powerful AI-driven investment colliding with elevated geopolitical and trade risks, leaving markets long fundamentals but short conviction. How tariff decisions, Arctic diplomacy, AI Capex funding, and consumer resilience evolve from here will shape whether this volatility resolves in renewed risk-taking or a more extended derating across assets. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.